Hi everyone, welcome to my channel, and I'm here to share with you about Warren Buffett's letter to shareholders to review his 58 years of investing tips. Berkshire Hathaway, Buffett's investment firm, has issued its annual shareholder letter. Here's an excerpt from the shareholder letter. I've made a lot of mistakes over the years. As a result, our portfolio includes a few companies with truly excellent economy, some companies with excellent economic characteristics, and a large number of companies on the edge. Along the way, some of the other companies I invested in failed, and their products were not favored by the public. Capitalism has two characteristics. It creates countless losers, but it also provides a lot of improved goods and services. Schumpeter, a prominent Austrian economist, calls this phenomenon innovative destruction. Whether high or low, stocks usually trade at really stupid prices, and understanding this is crucial. The effective market exists only in textbooks. Indeed, tradable stocks and bonds are puzzling, and their actions are only understood in retrospect. Controlling and non-controlling companies cannot be treated equally. Holding companies sometimes want ridiculously higher than reasonable prices, but almost never sell at a cheap price, and their owners will not consider selling at panic valuations unless compelled. At this point, my report card is fine. During the 58 years at Berkshire, most of my capital allocation decisions have not been sloppy. In some cases, even if I make a mistake, a bad move will be saved by good luck. Surprisingly, we make about a dozen good decisions, about one every 5 years. They're forgotten from time to time, benefiting long-term investors like Berkshire. Investment tips. In August 1994, Berkshire completed purchase of 400 million Coca-Cola shares over 7 years at a total cost of $1.3 billion. In 1994, our cash divided from Coca-Cola was 75 million, which has increased to 704 million in 2022. Dividends are rising every year, and just like a birthday, all Charlie and I have to do is to cash out Coke's quarterly dividend check. In future, these check amounts are highly likely to continue to grow. The same goes for American Express. Berkshire's purchase of American Express shares was completed in 1995. Coincidentally, cost another 1.3 billion. The annual dividend from the investment has grown from 41 million to $302 million. The amount is also expected to continue rise. These dividend yields are happy, not extremely impressive, but followed by a rise in their share prices. At the end of the year, our investment in Coke was worth $25 billion, while American Express was worth $22 billion, each representing about 5% of Berkshire's net worth, similar to the previous weight. If I had made a mistake and invested in the wrong company for the same amount, the company would have been mediocre, worth only $1.3 billion by 2022. The disappointing investment now accounts for only 0.3% of Berkshire's net worth and earns only around $80 million a year. This is a lesson for investors. When flowers bloom, weeds wither. Over the time, it only takes a few good companies to do miracles. Of course, starting investing early and try to live to 90 also helps. The past year. Berkshire did well overall in 2022. The company's GAAP operating profit, excluding capital gains or losses on equity holdings, hit a record high of $30.8 billion. Charlie and I both follow this data, and I hope you can do the same. Without adjustments, the GAAP data can fluctuate greatly on each reporting day. This magic set of 2022, which is not unusual. Seeing 100% of GAAP profits quarterly or even annually is misleading. To be sure, capital gains have been crucial for Berkshire over the past few decades, and we expect it to have a positive impact in the coming decades. But quarterly changes, often unconsciously making headlines by the media, completely mislead investors. Another good news for Berkshire last year was that we acquired Allegheny, a property insurance company, at the helm of Joe Brandon. I worked with Joe, and he knows about everything about Berkshire and the insurance industry. Allegheny brings us special value thanks to Berkshire's own special super financial strengths. Its insurance subsidiaries can follow valuable and lasting investment strategies, which almost no competitors can reach. With the help of Allegheny, our insurance flow increased from $147 billion to $164 billion in 2022. With rigorous underwriting, these funds will most likely become zero cost over time. Since acquiring the first property insurance company in 1967, Berkshire have increased float by 8,000 times through acquisitions, operations, and innovations. Although not recognized in the financial statement, the float was an extraordinary asset for Berkshire. In 2022, Berkshire, Apple, and American Express all conducted share buyback moves, which made our intrinsic value earnings per share very low. Apple and American Express are our two important investments. Berkshire directly increased interest in our unique business by buying back 1.2% of the company's outstanding shares. And the Apple and American Express buyback made Berkshire increase ownership without paying anything. This calculation is not complicated. When the number of stocks falls, your interest in many of our businesses rises. If you buy it back at an added price, every little bit will help. It is also certain that the company pays a lot for our buyback. At such things, earnings will only go to shareholders selling shares and investment bankers who recommend stupid purchases. One thing to emphasize is that gains from overweight buybacks can benefit all owners in every way. Imagine a car dealership with 3 well-informed shareholders, one of whom is running the business, and a passive owner who wants to sell its interest back to the company at a price attractive to 2 other shareholders. Does the deal hurt anyone? Are managers favored in some way over persistent passive owners? Is the public being hurt? When you're told that all buybacks are harmful to shareholders or the state, or particularly beneficial to the CEO, the person who advises you is either ignorant of the economy or an eloquent educator. The two are not mutually exclusive. Charlie and I, and many of Berkshire shareholders, is like to look like the many facts and data about operational data, but these are not required reading. Berkshire has so many billionaires, and yes, they have never studied our financial numbers. They knew only Charlie and me, and our family are close friends, and they'll continue to invest heavily in Berkshire. And they continue to believe that we would treat their money as we did our own. Finally, an important caveat. Even we who like operating profit data are easily manipulated by managers who want to do so. The CEO, the directors, and their advisors often find the adjustments very complex, and journalists and analysts embrace its presence. Above expectations was hailed as management victory. This behavior is disgusting, and it takes no talent to manipulate data. It just requires a strong desire to cheat. 50 years of everything. In 1965, Berkshire was a Bonnie holding and a long-established Badum New England textile company. As the company's business ground down, Berkshire needs to start over immediately. In retrospect, I was slow to understand the seriousness of the problem. Then good luck comes here. In 1967, was the state compensation insurance company, National Indemnity, emerging. We took the opportunity to shift our resources to insurance and other non-textile businesses. So we began our journey to 2023. While the bumpy road is, fortunately, our shareholders saving their retained earnings, the power of compound interest, avoiding major mistakes, and most importantly, riding the rapid growth in America have brought us where we are today. Even without Berkshire, the U.S. would not be affected, but without it, there would be no Berkshire. Berkshire currently holds an unmatched large, diversified businesses. Companies in the S&P 500 sectors earned $1.8 trillion in 2021, but only 128 of those companies, including Berkshire, made more than $3 billion. Another 23 companies are in the row. At the end of 2022, Berkshire was the largest shareholder of the following 8 giants: American Express, Bank of America, Chevron, Coca-Cola, HP, Moody's, Occidental, and Paramount Global. In addition to the 8 companies, Berkshire also owns 100% of BNSF and 92% of VH Energy, making profits exceeding the $3 billion mark. BNSF $5.9 billion and BHE $4.3 billion. Overall, Berkshire's 10 controlling and non-holding companies connect us to the lifeblood of the U.S. economic outlook to a far greater extent than the rest. In addition, Berkshire's insurance business, though conducted through multiple independent subsidiaries, has a market value to BNSF or BHE. In the future, Berkshire will always hold a significant amount of cash. Treasury bonds and a number of companies will also avoid cash scarcity in extreme situations such as financial panic and unprecedented insurance losses. Our CEO will always be the chief risk officer, and it is irresponsible to delegate this task. Moreover, our future CEOs will spend a large portion of their net worth on buying Berkshire shares with their own money, and our shareholders will continue to save and make profits through retained earnings. Berkshire has no finish line. Thank you for listening. Don't forget to subscribe and like. See you next episode.